Definition of finance. Finance is the management of money and other assets in order to achieve a desired outcome. It involves the creation, preservation, and management of wealth through various investments, such as stocks, bonds, mutual funds, and real estate. It also involves the management of risk associated with investments and other activities, such as banking, insurance, and financial planning. Personal wealth management. Personal wealth management is the process of managing your own financial resources and investments to achieve your personal financial goals. It involves creating a financial plan that is tailored to your needs, goals, and risk tolerance. This includes forming a budget, creating an investment strategy and portfolio, developing a retirement plan, and monitoring these activities on a regular basis. Professional wealth managers, such as financial advisors and investment managers, can assist individuals in developing and managing their personal financial plans. However, the ever-increasing Internet of Things allows you to research how to manage wealth yourself, massively reducing your cost. But don't worry, we'll start to talk about these subjects in the coming weeks off his blog to give you a helping hand. But now, let's look at a few of the investment opportunities out there which are available to us everyday investors, thanks to the power of the internet and market liquidity. Mutual fund investments. Investing in mutual funds is a great way to diversify your portfolio and build wealth over time. But many people don't understand how these funds work or the potential benefits they offer. We'll explain what mutual funds are and how they can help you reach your financial goals. A mutual fund is a pool of money that is managed by a professional fund manager. Investors pool their money together and the fund manager invests the money into a variety of different stocks, bonds, or other investments. This diversified portfolio allows investors to spread their risk across multiple investments and benefit from the potential for higher returns over the long term. Mutual funds offer several key benefits to investors. First, they provide a cost-effective way to diversify your portfolio and spread your risk across multiple investments. This helps to reduce your overall risk and protect you from the volatility of the stock market. By investing in a mutual fund, you can also benefit from the expertise of a professional fund manager who has the time and resources to research and select the best investments for your portfolio. Another key benefit of mutual funds is that they offer a variety of different investment options. Whether you're looking for a long-term investment or a short-term investment, there are mutual funds to fit your needs. You can also choose funds that focus on a particular sector, such as technology or healthcare, or invest in funds that target specific countries or regions. Finally, mutual funds are also a great way to invest for retirement. By investing in a retirement fund, you can benefit from the tax advantages that come with investing in a retirement account. This can help you save more money for retirement and reach your financial goals sooner. In conclusion, investing in mutual funds can be a great way to diversify your portfolio and reach your financial goals. With a variety of investment options and the expertise of a fund manager, mutual funds offer the potential for higher returns over the long term. And with retirement funds, you can benefit from the tax advantages that come with investing in a retirement account. So if you're looking for a cost-effective way to diversify your portfolio and build wealth over time, mutual funds may be the right option for you. Stock investments. Investing in the stock market can be a great way to grow your wealth and achieve financial freedom. However, it can also be a daunting prospect for many people. There is a lot to learn, and it can be difficult to know where to start. In this blog post, we will discuss the basics of stock investing and provide some tips to help you get started. First, it's important to understand what stocks are and how they work. Stocks are a type of security that represent ownership in a company. When you buy a stock, you become a partial owner of the company and are entitled to a portion of its profits. When the company does well, the value of the stock increases, which can generate a profit for you. The next step is to decide which stocks to invest in. There are a variety of factors to consider, including the company's financials, management team, industry trends, and more. It's important to do your research and understand the risks associated with each stock before investing. Once you've decided which stocks to invest in, it's time to purchase them. You can do this through an online broker or a traditional stockbroker. When buying stocks, you'll also need to decide how much to invest. This will depend on your goals and risk tolerance. Finally, it's important to stay informed and monitor your investments. This means reading up on the companies you've invested in and staying aware of any changes or news that may affect their performance. It's also important to diversify your portfolio and not put all your eggs in one basket. Stock investing can be a great way to build wealth, but it's important to do your research and understand the risks involved. With the right strategy and a little patience, you can achieve financial freedom. Real estate investing. Real estate investing is a great way to make a passive income. It can be a low-risk investment with long-term rewards. Investing in real estate can be a smart choice for those looking to diversify their portfolio and increase their returns. The key to successful real estate investing is to understand the basics of the market and the types of investments available. There are two main types of real estate investments: residential and commercial. 1. Residential real estate investments typically involve buying and renting out a single-family home, multi-family dwelling, or condominium. 2. Commercial real estate investments typically involve buying and leasing out office buildings, retail stores, warehouses, and other types of commercial properties. When considering real estate investments, it's important to understand the local market. Factors like population growth and job growth can have a big impact on the desirability of a particular area and the potential return on investment. It's also important to do your due diligence when researching potential investments. Look for properties that have good potential for appreciation and have a low risk of depreciation. Once you've identified a potential investment, it's important to understand the financing options. There are several types of financing available, including conventional mortgages, FHA loans, and private lenders. It's important to understand the terms of each financing option and the associated costs. When investing in real estate, it's also important to understand the tax implications. Understand the various tax benefits and deductions available to real estate investors and how they can impact your overall return on investment. Real estate investing can be a smart choice for those looking to diversify their portfolio and increase their returns. However, it's important to understand the basics of the market, the types of investments available, and the associated risks. Doing your due diligence and understanding the financing and tax implications can help you make a wise investment decision. Bond investing. Investing in bonds can be a great way to diversify your investments and generate a steady stream of income. Bonds are a type of fixed income security that pays a predetermined amount of interest to the bondholder over the life of the bond. As an investor, you can choose to invest in a range of bonds, from government bonds to corporate bonds. For those who are new to investing, understanding how bonds work and how to invest in them can be a bit overwhelming. Here are some key points to consider when investing in bonds. 1. Evaluate the bond's credit risk. When looking to invest in bonds, it's important to assess the credit risk of the bond issuer. 1. Government bonds are usually seen as the least risky, while corporate bonds can range from low to high risk depending on the company's financial standing. 2. Know your investment objectives. Before investing in any bond, it's important to understand your investment goals, such as whether you're looking for income or capital appreciation. 2. This will help you decide which type of bond to buy and for how long. 3. Look at the bond's maturity date. The maturity date is the date when the bond issuer will pay back the principal, or face value, of the bond. 3. Generally, the longer the maturity date, the higher the yield, but the higher the risk. 4. Consider the bond's yield. The coupon rate is the interest rate paid by the issuer over the life of the bond. 4. Generally, bonds with higher coupon rates have higher risk, but can offer higher yields. 5. Understand the bond's market value. Bonds are bought and sold on the secondary market, so it's important to understand the trading value of the bond at any given time. 5. Generally, the longer the maturity date, the more volatile the bond price will be. 6. Diversify your portfolio. Investing in a range of bonds can help reduce risk as well as provide a steady stream of income. 6. These are just some of the factors to consider when investing in bonds. Ultimately, the best way to ensure a successful bond investment strategy is to do your research, understand the risks and rewards, and diversify your portfolio.